Hi, my name is Patricia King, and I'm here today to talk to you about an overview of the Consolidated Omnibus Budget Reconciliation Act, otherwise known as COBRA. COBRA is a federal law that was enacted in 1985. COBRA offers group health plan participants the right to continue their coverage after qualifying events. Events include involuntary termination, with the exception of gross misconduct, loss of coverage due to layoff, strike, lockout, or medical leave, and loss of hours that result in a forfeiture of health plan coverage, loss of coverage due to a death or divorce from a spouse who was formerly covered by the group health plan. Organizations that are eligible for COBRA must have more than 20 employees. Depending on specific circumstances, coverage can last from 18 to 36 months. Individuals are required to pay their entire share of healthcare coverage. This amount includes the portion that the employer historically paid and the employee's historic paid portion, with addition to an imposed 2% administration fee that goes directly to the employer. COBRA positively and negatively impacts individuals, employers, and payers. For many individuals, specifically those succeeding a job loss, the cost of COBRA continuation coverage is absurdly expensive. On average, the total annual cost of employer-sponsored health coverage offered by a firm of 20 or more in 2019 was $7,012 for single coverage and $20,599 for family coverage. For someone without a job, COBRA has been historically difficult to afford. The Medical Expenditure Panel survey found that 130,000 of unemployed non-elderly adults had health coverage through COBRA in 2017 out of an eligible group of 11.5 million non-elderly adults, thus proving that utilization of COBRA has had minimal impact and does little to prevent coverage forfeiture among individuals experiencing job loss. On average, 33% of COBRA enrollees are 55 years of age or older and are likely to have multiple chronic conditions and more likely to have poor health status. This uniquely poses the question of effectiveness and affordability of COBRA. Employers have a vital role with COBRA and face consequences if they do not comply. Employers have 1 month from a qualifying event to notify the group health plan administrators. Additionally, the employer's group health plan administrator is required to send a notice to the employer beneficiary within 2 weeks of receiving notification of the qualifying event. Employers are prohibited from charging more than the cost of a health premium, but are allowed to add an additional 2% charge for administration fees. The employer's group health plan are able to choose to provide longer coverage than mandated under the statute. If the qualifying event is termination of employment or reduced working hours and the former employee becomes eligible for Medicare in less than 18 months from the qualifying date, coverage for a spouse or any dependents may last up to 3 years after the employee's Medicare eligibility date. So what happens when an employer does not abide by COBRA requirements? Employers violating COBRA mandates face a tax penalty of up to $100 daily for each affected former employee and every violation. Companies are also subject to Employee Retirement Income Security Act penalties that can reach up to $110 daily, starting from the date that the employer fails to comply. Noncompliance can result in IRS charges of a minimum of noncompliance tax of $2,500 with a maximum tax of either 10% of the amount of the employer paid during the previous year for the group health insurance or $500,000, and can hold employers personally liable for noncompliance with COBRA statutes, and companies are forced to pay any legal and accounting fees during the audit process. Payers are also impacted by COBRA. Commercial health insurance plans may lose money from COBRA due to the significant number of individuals that decide not to elect it. Those premiums and memberships that were once bringing in revenue may quickly stop. They may also see a rise in healthcare expenses for those who elect to obtain COBRA due to the likelihood that they will have multiple chronic conditions and poor health status. This could cause unfavorable financials and be difficult to manage. In 2021, the federal government passed a $1.9 trillion relief bill to COBRA premiums for 6 months. While data has not yet surfaced, this subsidy has directly impacted federal expenses, may increase COBRA enrollment, and may sustain employer-based health plan memberships. Government programs such as Medicare and Medicaid are also affected. Depending on what insurance is obtained first, COBRA or Medicare, insurance may be combined or stop. Individuals that have Medicare while they enroll in COBRA are generally able to keep both. Individuals that have COBRA when they become Medicare eligible lose COBRA coverage when they get Medicare. However, spouses and dependents may be eligible to keep COBRA for up to 36 months, and individuals may still enroll in COBRA additional coverage services that Medicare doesn't cover. Medicaid and marketplace coverage is also an alternative to COBRA. While they may have limited networks and options compared to COBRA, they may be more affordable. During the COVID-19 pandemic, Medicaid saw a $5.5 million growth. One can only wonder in what determining factors drive someone to select alternative options for health insurance, and if COBRA is always really truly the best option.